that no matter which legal structure is used, creditors always have first claim on the assets if the business fails. However, a corporation, as a legal entity, limits the financial risk of the owners to the amount of capital invested. In other words, stockholders of a corporation are not liable for more than they invest. Charlie forms the corporation under the laws of the state, names it the New Design Chair Company, and selects a few individuals to act as the board of directors until the first annual meeting of stockholders. At that time, a board of directors will be formally elected by the stockholders. The directors decide to issue 250,000 shares of stock of the 400,000 total possible shares authorized by the company's founding charter. When the company was organized, this was the number determined to be the most convenient for the company's needs. The 250,000 shares are divided between Charlie and the venture capitalists in proportion to their agreed ownership, determined by the contribution of each. Charlie still owns a meaningful amount because of his importance to the company, his chair patents, and his initial capital. Now it can be said they are indeed stockholders in common. Each stockholder is a part owner in the company, although the extent of ownership depends upon the number of shares held. An individual who holds 50 shares of the total 250,000 shares issued owns 1/5,000th of the entire company, whereas a person who has 10,000 shares owns 1/25th of the company. The remaining 150,000 shares might be issued by the directors at a later date if the company finds it necessary. However, at the present time, the company's ownership is divided into 250,000 pieces. In other words, there are currently 250,000 shares outstanding of 400,000 shares authorized. The members of the board of directors, including Charlie, are elected by the stockholders to oversee the affairs of the company. Each share outstanding, according to the company's charter, is entitled to an equal vote in the annual election of the directors. The New Design Chair Company is now a private corporation owned solely by its small group of founders. However, later they might allow the public to participate. If so, stock would be sold to these new investors through the company's initial public offering, or IPO. But first, a track record needs to be established before going public. Most of the initial $2 million has been contributed in the form of equity capital by the venture capitalists. To raise the remaining capital, the company decides to go into debt. If the company were to borrow this money expecting to repay it in a relatively short period of time, a bank could be approached for a loan. If a longer time period is needed, a few years or more, the company might consider selling bonds. The New Design Chair Company, being a young, unproven business, would probably be unable to issue bonds solely on its word or good name. If it could, bonds of this type would be called debentures. Lenders are usually reluctant to loan money to a new firm without security. Consequently, the New Design Chair Company might be asked to put up some property as collateral. Bonds of this type are often called mortgage bonds. Although the New Design Chair Company would have to pay interest on the money it borrows, present holders would not have to give up ownership, as Charlie did when the new stock was issued for equity capital. On the other hand, the lenders, the bondholders, do have first claim on the company's property if the company fails to repay the debt. Such a failure is called a default. The importance of profits. Why would Charlie and his associates risk their personal savings to build a factory to manufacture the chairs? They could have deposited their money into a bank account rather than investing in the new enterprise. The money would have been safe, and the bank would have paid them interest. Why would anybody be willing to risk money, let alone $2 million, to start the New Design Chair Company? The answer is simple: profits. Charlie and his associates saw an opportunity to make a good profit on each chair manufactured if the company met its business objectives. The stockholders also saw the possibility of increasing their profits in later years if more chairs could be manufactured and sold. In short, Charlie and his associates figured they could achieve